Hello and welcome to Morning Brief Market Sunrise. I'm Josh Schafer in for Ramzan Karmali, live from Yahoo Finance's studios in New York. It's Wednesday, July 16th. U.S. stock futures are treading carefully again today as bond yields have picked up in recent days. We'll have a closer look at what's pushing investors to scale back their bets on Federal Reserve interest rate cuts in the near future. Plus, we'll delve deeper into the world of precious metals and why one Wall Street firm is raising its outlook for silver prices. And finally, earnings season rolls on. We'll have the latest numbers from Bank of America as well as Johnson & Johnson throughout the next half hour. So grab your coffee and let's own the morning. Let's kick things off with what you need to know before the opening bell rings by taking a look at futures. It's a bit of a mixed picture this morning with futures tied to the tech-heavy NASDAQ down about 0.2%. You can see Dow Jones Industrial Average futures a little bit above the flat line, but largely stocks relatively flat this morning. That roaring rally in U.S. stocks has pressed pause as traders reassess their expectations for Federal Reserve interest rate cuts, and bond yields have moved higher following a Tuesday inflation report that showed price increases accelerated in June. The 10-year Treasury yield has added nearly 15 basis points in the past week and is now approaching the key level at 4.5%, where it's sometimes weighed on U.S. equities. And meanwhile, the 30-year Treasury yield has surpassed 5% for the first time since late May. Tariffs remain a key part of this story, of course, as investors wait for more updates on President Trump's trade plans and assess how those new duties could potentially keep inflation higher. On Tuesday, Trump said levies on pharmaceutical companies will, quote, probably come at the end of July, while adding that tariffs on semiconductors will likely be implemented on a, quote, similar timeline. Despite that tariff back and forth, portions of the tech trade have continued to chug higher. Nvidia closed at a record high on Tuesday, above $170 a share, as the company said it hopes to begin selling H20 AI chips in China soon. Nvidia CEO Jensen Huang spoke briefly at an exhibition in Beijing on Wednesday, telling the audience AI models from Chinese firms DeepSeek, Alibaba, and Tencent are, quote, world-class. After an aggressive rally on Tuesday, though, chip makers are taking a step back Wednesday morning. That's following quarterly results from ASML. The supplier of computer chip-making equipment said it may not achieve growth in 2026. ASML notes macroeconomic uncertainty and geopolitical developments are weighing on the outlook. Shares of the chip linchpin fell more than 7% in pre-market trading following the release. Also weighing on shares of Micron, AMD, and Marvell. You can see Marvell down nearly 2%. I want to stick with the AI trade. Intelligent Alpha founder and CEO Doug Clinton joined Julie Hyman on Market Catalyst, and she first asked him about where we are in the AI cycle. Let's get a temperature check.
I would say the temperature is probably a little bit elevated right now, Julie. I mean, you think about AI over the last 2 years, it's felt like this sort of nonstop train where we've had increasingly impressive model releases from the large model building companies. We've had, to your point today, energy investments, companies building gigawatt investments in energy. Meta, as an example, right? Microsoft, Amazon, all of them are trying to make sure they have enough power for their systems and their chips. And so I think that we're going to continue to hear a lot of news about AI over the next 3 to 5 years. We still think we're in the midst of a 3 to 5 year bull market for the AI trade. To your question about temperature, though, I think if you think about that long term, think about 3 to 5 years, and we think AI has this kind of up and to the right trajectory. Along that trajectory, you will have times where you sort of undulate above and below that long-term trajectory. I think we're probably above that right now. So we are heated. We've had a lot of AI stocks up 100+% in the last few months. And so maybe it's time for things to cool down a little bit, but don't miss that long-term trade. That's the way that we're approaching it.
So I guess it depends on what your investment horizon is, right? If you're looking over the longer term, maybe there's still room for you to get in. And you guys, you use fundamental analysis, but you also use AI analysis to help you choose stocks. So I know AMD is one of those that you're looking at. And in addition to Nvidia getting the go-ahead or expected to get the go-ahead to reship into China, AMD has said it expects to get a similar approval. Is that a potential catalyst here, or what are you looking for big picture?
It is a catalyst for AMD. And I think AMD, it's funny, the story has always been for the last year plus that everybody who is building these data centers, they want an alternative to Nvidia. We just want diversification in the supply chain. And AMD has always been the best bet to be a second option. Their chips haven't really delivered. There hasn't been as much demand, I think, as people had hoped for them. And actually, that story hasn't changed, but we've kind of come back. It feels like the stock sort of got washed out. All of the optimism that I think there was that they would really become this second player last year is gone. And now the story, it's kind of come back a little bit, where they just announced their MI400 chip. Sam Altman was on stage at that announcement. And so they are trying to push some of these bigger partnerships. And I think it's one of those stocks where if they can get some momentum in their fundamental business, then this is one that could have maybe better longer term upside. Think about it, 6 to 12 months than Nvidia, because it's not valued the same way.
Breaking news, Bank of America just reporting second quarter earnings. The bank posted an adjusted earnings per share of 89 cents per share, higher than analyst expectations of 85 cents per share, and then revenue coming in at $26.5 billion. That's roughly in line with estimates. You can see on your screen now, stock rising in reaction, up about almost 2% at one point, now up a little bit over 1%. I do want to highlight a quote from Bank of America CEO Brian Moynihan. He had some commentary on the U.S. consumer saying, quote, "Consumers remained resilient with healthy spending and asset quality, and commercial borrower utilizations rates rose." So a healthy consumer is what Bank of America is seeing here, and I want to get you a couple other key numbers within this release. So net interest income for the second quarter from Bank of America coming in at $14.67 billion. That was above estimates for $14.6 billion, so slightly above estimates there. A key metric, though, that seems to maybe be driving this stock higher right now, I want to look at trading revenue. Trading revenue in the second quarter for B of A coming in at $5.38 billion. The street was looking for $4.94 billion, so a pretty big beat on trading revenue there. Now remember, that was a story we had been following yesterday as well. Citi also going up higher yesterday on trading revenue. Of course, this follows a relatively volatile market quarter for the second quarter in tariff reaction, so you're seeing the banks sort of benefiting from some of that. We'll be watching how that impacted Goldman Sachs and Morgan Stanley later on today. And then I also want to take a look at different sides of this stock move you're seeing right now. So Bank of America up almost 2% right now, but you're looking at that one-year chart. Stock had only been up 10%. You flip over to JP Morgan's estimates from earnings from yesterday. Stock didn't really move well on relatively strong earnings, but stock had been up over 40% over the past year. So perhaps you're seeing a little bit of a difference there. A final number I want to bring you from B of A, looking at the second quarter, investment banking revenue coming in at $1.43 billion. That was above estimates slightly, and that was an interesting, above estimates for $1.27 billion. Yesterday, remember, JP Morgan investment banking had been a key metric for them. Investment banking had come in higher than expected. We've been watching sort of as we delve into these releases, and certainly you'll be able to see this in Morgan Stanley and Goldman Sachs later this morning, how the pickup in the M&A market, pickup in the IPO market might be impacting deal making and that part of the business. Overall, relatively solid report, it seems, from Bank of America. Market seems to be enjoying this one. Again, stock up almost 2%. We'll be keeping a close eye on that earnings call later this morning, and we'll be giving you more updates on the financial sector throughout the morning on our morning brief show later. We'll be back after a short break. Stay tuned for much more coverage. Welcome back. Gold, copper, and silver have been shining in the markets this year, with silver outperforming the others. And just think about this. In percentage terms, silver has risen more than Nvidia this year, with the precious metal up more than 28%. And this morning, Citigroup says that unlike gold, which might be losing its sparkle after a massive rally, silver is set to continue to soar above $40 an ounce. You can see right now it's trading at about $38. So what's driving the metals market, and what do you need to know to get your next trade right? In this episode of Stocks in Translation, Jared Blickery breaks it all down.
I'm going to start by charting some of the moves in Dr. Copper, because this is where we have the most zigs and zags over the last 25 years. So this goes back to the beginning of the century, and we can see right now we're at $5.51 per pound. That is a record high. But if we go back to the beginning of the century, guess what? We had a little bit of a slump in the wake of the dot-com boom and then bust. But starting in 2003, we saw a big rise there. And that was as China actually joined the World Trade Organization, or the WTO. That lasted into the global financial crisis. Then we had a pretty big bust in Dr. Copper, and then we had another rise. And that rise was due to unprecedented stimulus, not only from the Chinese government, but also from the United States government. QE was in force, and then we saw kind of a strong dollar play. That weighed on this metal all the way into the beginning of 2016. The entire world, most of the world indices went through a bear market in 2015, and then 2016 we found the footing. And that was actually the year that Trump began his first presidency. And from there we saw some zigs and zags, and then we saw a shock into the pandemic. A couple of years of deflation or semi-deflation, disinflation, that caught up with it in 2022, but then it was off to the races again, and especially with the Trump tariffs now on copper threatening to be 50% on August 1st, we're seeing a lot of front running in this trade. Now, I also want to show you gold futures, and I'm going to show you silver as well, and they follow a very similar pattern. We're not seeing the dramatic zigs and zags that we did in copper, but we did see the same pattern of China joining the WTO, contributing to that huge rise in price to $1,800, almost $2,000 an ounce by the beginning of the global financial crisis. Saw a little bit of a meltdown there, but in 2016 into 2018, we saw a bit of a rise into the pandemic, a little bit of a whipsaw there, and consolidation over a few years. Again, that 2022 bear market in US stocks, that contributed to some deflation and disinflation globally. Supply chain shocks came into force again, and then we saw this huge rise beginning in late 2023, and we are now at $33.53. We've seen a high of as much as $3,500 per ounce. And gold is kind of unique among the precious metals and also the industrial metals, and this is because central banks have been a huge determining force in their buying of it. This is a bar chart that shows central bank buying in tons going back all the way to 2010. And what you notice here is the last 3 years, 2022, 2023, 2024, all of those had gold being bought by central banks in the amount of over 1,000 tons. And so that's a pretty big dramatic increase from the prior years. And this has to do with the ongoing de-dollarization in China as well as Russia, but also a host of other countries, even some in Western and Eastern Europe. So this is a trend that we want to follow. I want to close out here with silver, and I'm going to just chart the price action. Again, very similar chart to gold and copper in terms of the big movements here. We saw a big price spike into almost $50 per ounce, and that was just as the global financial crisis was getting underway, and then the QE area in 2011. That's when we saw that high. Then we saw a dramatic crash into 2016, kind of found its footing, saw a big squeeze in the early pandemic. 2020 was a great year for silver, but then we saw a little bit of a fallout. And again, silver is on the rise here at $38. It's still off of that $50 record high, but it is increasing very quickly. To round out the conversation, I want to just present a table here. I have all three metals, and just kind of grouping them together, I want to display how they are moving with their specific patterns, with a trigger, and then to tell you which one of these is featured in these specific criteria. So here, under the pattern, we have acceleration. So that would be an economic acceleration. The trigger would be liquidity. And when that happens, we see all metals benefiting from that. And then when there's a safe haven scare, and that trigger would be a crisis of some sorts, you're going to see gold and silver outperforming the most, kind of leaving Dr. Copper behind. And then here's a bearish one. Industrial drags, that affects copper disproportionately here, and the trigger there is typically a stronger US dollar, because the US dollar surges when global industrials tend to drag, and that's because the US is the least dirty shirt in the laundry basket of the world. And then finally here, we have a policy shock. This will affect all three metals, but especially copper and gold here. Arguably, the biggest reason is tariffs and debt, and we've seen both of those contribute to silver rising, so we could put all three in that basket as well. But when you put it all together, we have the perfect explosive mix for all three of these metals, including palladium and also platinum, which we didn't have time for. But all of these are experiencing huge thrusts in 2025, and we'll have to see how these tariffs play out, especially on Dr. Copper with respect to that August 1st deadline. Remember, 50% there. So tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
A great explainer from Jared there, and I want to add one more note on metals. If you want to understand the impact of President Trump's tariffs on the real economy, take a look at aluminum this morning. The mining giant Rio Tinto just said that U.S. tariffs on its Canada-made aluminum have added $300 million in costs in the first half of this year. Trump hit Canada with a 50% tariff on aluminum and auto parts in June. Earlier this month, other companies like Constellation Brands, the owner of Corona Beer, also pointed out that higher aluminum costs from tariffs, highlighting that sooner or later, those price increases will be passed on to consumers. Stay with us. We'll delve into more trending tickers after the break. Now, some more breaking news on the earnings front as the pharma sector braces for more clarity on tariffs. Johnson & Johnson reporting earnings this morning, kicking off earnings for the healthcare sector. The company reporting second quarter adjusted EPS of $2.77. But key part of this release really is the company boosting its full-year sales outlook and boosting its full-year earnings outlook, its profit outlook. So Johnson & Johnson now seeing full-year adjusted earnings per share in a range of $10.80 to $10.90. Previously, it had guided for a range of $10.50 to $10.70. On full-year sales, the company now sees a range of $93.2 billion to $93.6 billion. Previously, it had seen a range of 91 to 91.8. So you're seeing stocks slightly higher here, up a little bit over 1% on this boosted forecast. But key, though, for the sector, as we had talked about earlier this morning for Johnson & Johnson, is the fact that pretty soon President Trump has warned that there will be tariffs coming on the pharma sector. So it will be interesting to see, of course, how those could impact this company, what management says on the call about those tariffs and looming risks when it comes to that. Now, you might have also heard about MP Materials in recent days. That stock closed 20% higher on Tuesday, and this is another trending ticker that I want to highlight for us. That stock is up about 4.5% in pre-market, up almost 4% now. The fresh surge in MP, that's the ticker, comes after Apple announced that it would buy rare earth magnets from the company in a $500 million deal. The deal we'll see Apple and MP Materials launch a recycling facility in California for processing, and we'll be keeping a close eye on MP Materials over the next several sessions. And also taking a look at our call of the day here. So bets on Federal Reserve interest rate cuts are fading as recent data has shown signs of sticky inflation while the labor market remains on stable ground for now. On Tuesday, the latest consumer price index report showed core prices, which exclude the volatile food and energy categories, increased 2.9% in June. That's compared to the prior year. This marked an acceleration from the 2.8% growth seen in May. Following that release, odds of a Federal Reserve interest rate cut in September tumbled. Data from the CME Fed Watch tool shows traders now see just a 52% chance the Fed cuts rates in September. That's down from a 70% chance seen just a week ago. Still, some traders and even President Trump have been hopeful interest rate cuts will come sooner than September. John Hilsenrath, StoneX senior advisor, and Eric Winograd weigh the merits of a rate cut this month on the market on Catalyst with Julie Hyman.
Frankly, I think there's too much attention right now on the tariff effects. And not enough attention on just the underlying rate of inflation. The Fed's goal is 2% inflation. So let's say there's been very little effect of tariffs so far. The inflation rate is still a little bit above the Fed's 2% target. And what we saw with the number today is consistent with that story. We had 4 straight months of readings that were low of 0.2 or below. And this month we got a reading of 0.3, which is consistent with like a 3 or 4% inflation rate. I like to look at the price of a haircut. I think that tells you something about the rate of domestic inflation. The biggest inputs in the rate of a haircut are labor and rent. And that's going at a rate of 3.5% to 4%. That's got nothing to do with tariffs. It's got nothing to do with the exchange rate. It's the domestic economy. And I think the Fed doesn't have inflation at the 2% goal. It's really, in my mind, they're going to find it hard to justify cutting rates a lot in the months ahead if they're hovering a little bit above the 2% rate objective, inflation rate objective, regardless of what tariffs are doing.
Breaking news, we got to make the Hills and Wrath haircut index. Heard it here first, folks. That's what we're going to be introducing to the economic world.
You can see the chart on my LinkedIn page. I just posted
I need to spend more time on LinkedIn. Eric, is part of this that the Fed needs to bring down that inflation target? Or I should say bring up that inflation target, excuse me. Is that part of the issue here?
So look, the Fed can't change the inflation target. It's no good changing a target when it's convenient to do so, because then you lose credibility. I think it's reasonable to argue that the target should have been set higher when they originally set it, but it's a little bit late to do that now. It's just you can't change it midstream without risking your credibility. I disagree with John to a certain degree, though. I don't think the Fed has to wait. In fact, I think it would be a mistake for the Fed to wait until inflation is all the way back to target before they contemplate cutting rates.
But what's the argument for cutting rates sooner?
So the argument for cutting rates sooner is that inflation tends to lag the economic cycle, right? If you wait until it's all the way back to target, you have almost certainly waited for the economy to weaken too much. So I agree, you need to see downward momentum, and I think that the Fed agrees with that too. But take the counterfactual. The Fed did cut rates last year. If they hadn't, rates would be quite significantly higher now, and I don't know that anybody really thinks that would be appropriate for the economic circumstance. The Fed, much as they are data-driven, also needs to try to be forward-looking, and when you see indicators that suggest inflation is going to come down, you want to respond to that. I'm pretty confident that were it not for the tariff overlay, the Fed would be cutting rates right now. I think the underlying dynamics are consistent with the gradual progress toward that target. It is the uncertainty that's restraining them. And we can debate whether that's appropriate policy or not. Within the Fed, there's a debate. If you think about the dot plot right now, roughly half the committee doesn't think they're going to cut rates at all this year, and another half of it thinks they're going to cut rates at least twice. So these are reasonable disagreements to have. But unfortunately, from a market perspective, this is a disagreement that's going to persist because the data aren't giving us a clear answer.
John, what do you think of that view?
Look, can I take the bait on this debate? And I think you answered my response, which was that the Fed has already cut interest rates. They cut interest rates by a full percentage point last year. They did some of those rate cuts before the election and some of those rate cuts after the election. So some of them may have benefited Biden and some of them benefited Trump, but they got the short-term rate down a full percentage point, and now they're waiting to see if there's follow-through and if inflation is continuing to recede. So is it continuing to recede? I think another way of looking at this is I just don't think the neutral rate, the rate at which the economy is producing either less inflation or more inflation, is where the Fed puts it. The Fed has said it's around 3%. I think it's closer to 4%. The Fed funds rate is a little over 4%. I just don't think they've got a lot of room to cut rates much more unless they want to create more inflation. And that's the risk they're going to run. And frankly, if the president gets what he wants and the Fed cuts rates by 3 percentage points, we're going to get a lot more inflation.
That's Market Sunrise for this morning. Stay tuned for Morning Brief at 9 a.m. Eastern. I'm Josh Schafer. Go on the morning.